Okay, well, I just started the recording. I'm talking with Shelly, who you'll be able to hear if she makes comments, and the video is obviously on me. What I had in mind to talk about was how to plan investing to go very well. So you have a moderate or low amount of risk, a really high probability of success, a really high probability of profits, meaning lots and lots of profits, and relatively few losses, relatively small losses. So already that, sets up some of what I wanted to talk about, just, that basic thing. But Shelley, I may get into a deductive inquiry kind of conversation with you, where I'm, inviting you to give input about, some contrasts and what preferences make sense to you.
Okay.
Um, so the thing that I had previously referenced was, if you take any amount of time, a year, a week, a day, within that period of time, there are some periods of time that are average quality in terms of when it's how good a time it is to invest. There are going to be some periods of time where there's a really high degree of uncertainty, and uh, or really like low volume would be another reason why it would be, really boring. So, the hour right before market close, right before a holiday, a lot of times there's nothing going on. So you just, unless there's a huge political news item, nothing's going to happen in the last hour of trading right before a holiday. It's going to
Mm-hmm.
move, 0.5% or not 0.5%, 0.05% or really, really small moves. Like that's as much as is going to happen. It's going to be very flat. So it's not very interesting. So one of the things that makes something an above average time is there has to be some price change, some significant price change. But we can also pick, there will be times when price change is so abrupt or so uncertain that we might see that as unfavorable. So um, there's going to be some above average times, uh, whether we pick a year as our time period or an hour or a day. There's within whatever period of time, there's going to be above average and below average and average uh, quality of market activity for that time period, right?
Mm-hmm.
So that's I don't know that I've ever made that point, but that's a very, very basic point of logic. So one of the things that would be really interesting is to have some sense of what is an above average time to engage in trading. What kind of indicators, what kind of data, what kind of patterns that are objectively observable, what can we recognize as good for trading, good for profits, good for keeping losses small. If you can kind of maintain this whole set of um, values that I've stated, I want to bring all of that into what makes a particular time a good time to trade. And I'm ready for your short or long comment.
Um, I'm just ready to hear what you have to say.
Okay. Did I? So nothing I've said to you before comes to mind now when I raise this question. Like, what would make what? Let me ask this way: what
Mm-hmm.
pattern in a shape in a chart? What pattern would be notable and interesting as it relates um, to profitable trading, high probability trading?
You're looking for me. Well, I'm curious to know what the patterns are. I mean, I assume that you know them,
Yep.
so
Well, I'm
I'm
asking for you to be as really general as you can. So, because if other people listen to this, I'm not expecting them to have any jargon, an advanced vocabulary. Just from a very casual observer perspective, what kind of things. When I say it, it'll probably be really obvious to you, but I was just wondering if you can come up with it, with anything. So
What
what?
kind of things
Yeah,
are?
what kind of things? And you can answer. You can go outside of the questions that I ask. I'll come back to my questions, but what makes a particular time a good time to trade? And the sub question I was asking was, what patterns of price movement in markets make it a good time? And this is, I'm
Well, I
hoping
would
that I've already
think
primed you to know what I mean by that. So go ahead.
I would assume that when the markets drop, it's a good time to buy, and then when they start to raise
Okay.
again, it's a good time to trade.
Okay. When you mean so when markets are going down, look to buy, and then when markets are rising, look to sell.
Right.
Okay, so that's correct. That is not the specific thing I had in mind, but that's absolutely correct. That does point to um, um, a very basic issue that I can bring up in a moment. Let me go ahead and give like the quick answer to this
Okay.
item, and then we can come back to the detail of it as relevant. So, what I want to see when I'm going to enter a trade or going to start investing, I want to see a trend. Just that's it. I want to see a clear trend. Specifically, I want a trend channel would be really nice to see, and you know what I mean by that, right?
Mm-hmm.
So a trend channel would be, parallel highs and lows, a series of highs and lows that form a parallel set of two parallel lines, or a channel. Most of the time, we're talking about in nominal price, but it could be in this is a needless complexity, but it could be in log scale. If the chart is a trend channel in log scale, that's okay. Do you even know what I mean?
No.
Okay, that's not important. Um, so um, we want to see a trend channel or some other set of trend lines. So if you have two parallel trend lines, then we call that a channel. If you have two converging, I have to figure out on my screen. Let me see. I'll go over here. Right. Okay. These converge. So if there's two trend lines that are both straight lines and they both converge on a particular point, making a triangle, that's a converging triangle. And that is a identifiable pattern, and it sets up particular, you know, there's a particular clear, explicit, observable framework for trading. So it's pretty nice to have a clear trend, and not just a trend in the general sense, but some trend lines. In fact, two opposing trend lines, meaning a high or a line of highs and a line of lows, right?
Mm-hmm.
So trends is kind of the throwaway casual answer, but specifically trend lines, trend channels, triangles. It can be diverging triangles or converging triangles, if you even know what I mean by that, but trend lines, okay? So that's a very crisp, basic answer. So you know what I mean by that, right?
Right.
And you've seen charts of various different markets, so you know there are trend lines. They don't have to be flat. Again, a trend channel typically is going up or going down, right?
Right.
So a flat trend or a stable line of support and line of resistance, those I am interested in those, but I'm not interested in. I'm actually not as interested in those. And a lot of this is a somewhat trivial side detail. A lot of investment analysis about charts, they're talking about support lines as a flat line and resistance lines as a flat line, and those are actually the least interesting trend lines to me in the long run. I'm definitely interested in them in. No, that's not the way to put it. They're the least interesting lines to me in the in everyday trading situations. But as far as long term uh, um, indicators and long term signals, I'm definitely am interested in support and resistance lines that are flat lines. I just in everyday, especially short-term trading, you know, trades that I'll hold for hours, weeks, minutes, days, any of that kind of thing, then uh, just a simple support line, you know, or a simple resistance line, a horizontal line like that isn't as much interest as an actual set of trend lines that are at some angle. So I'm saying all this. This also gives you the opportunity, if you'd like, to say, why is that? So if you want to know detail now or later, you can let me know.
Yeah, I would like to know now why you're more interested in the parallel ones aren't as, or the flat ones aren't as interesting to you
Okay.
as one with some movement.
Well, I think I need a visual aid.
By flat trends, I'm assuming you mean there's not a huge potential for gain and not a huge potential for losses. That it's just sort of steady.
Okay, yeah. So, here is our market activity in the curved line, and then the flat line, that would be what's called a support line because it's below prices. So we tend to,
I don't see what you're.
What?
I don't see what you're referring to, but should
okay,
I?
So do you see the flat line?
No, I see your desktop with a black.
Oh, you don't even. Oh, okay. I thought we were doing a screen share where you were going to see my video. You don't see my video?
No.
Oh,
I
good
don't
Lord.
see your video.
That totally technical error. So I've got a bouncy line with a flat line under it. It looks like I'm going to need to. I can't just draw something and throw. Oh, I guess I can flip it back. So I'll click over to see if I can click over. Yeah, I believe I'm going to be able to show you this. I just have to. A little awkward because I have to turn off screen share and turn on my video, but we can do this. Oh no, look, it's telling me I can't do that while I'm recording. I'm gonna have to pause the recording. Okay, we're learning as we go. All right, so Shelly had the opportunity to see this image, and so Shelly, I don't know if I had asked a question before I stopped recording, but you've seen the image,
right?
So the pattern is every time it comes down to this line, we're thinking like this is time. So this is at 8 a.m., 9 a.m., 10 a.m., 11 a.m., for instance, right? You got the idea of that? You can't see me, but you got the idea of what I mean?
Yeah, you're talking about the trending upward line?
Yeah, the bouncy line.
Right.
Just over time, it comes back down to the, the price line is the one that's bouncing. The flat line, I've just drawn that myself. That's not really there, right? That's just some fantasy I put together because I saw a pattern, and humans identify patterns. That's what our brains do. So that pattern absolutely doesn't predict anything. Just to be clear, that trend line and the pattern is not predictive. What it does do is set up some clear points of reference that I can use to then make presumptions. But I do want to distinguish that, trend lines aren't in themselves predictive, as an aside.
Okay.
However, if 60% of the investors that are following a certain market are watching that trend line, and if it then falls under the trend line and starts to really move very quickly, then I can conclude, wow, I think what happened right there is a bunch of people were using that trend line as a psychological point of reference, whether consciously or unconsciously. Once that point got passed, now there's something really distinctive happening, or there could be. Does that make sense? All right, so we got the bouncy line. And in that case, if it breaks the lower trend line or the support line and the price starts to plummet, then I can say, okay, that's a trigger to enter. So, or to sell short, for instance. Do you understand my terminology, Shelley?
Can you explain sell short?
To take a position that will benefit from a continued drop in the price of that particular instrument.
Got it. Okay.
It's actually the same as short sale a house, but we don't need to get into that. So I have an entry signal. If it breaks that line, enter. So there was a trend and my trend's broken. Oh, interesting. The trend that did exist is now broken, so I enter. So that's what a trend, that's what a support or resistance line can be used to do.
Okay.
And it's actually a pretty good signal for getting out. So if I'm in a particular, position and it breaks a support line, a horizontal trend line, then I might say, well, that's a trigger to exit. But as a trigger to enter, one of the issues is there's no indication of where I would exit from this trend. So it's actually a breach of trend. Once it breaks that line, it's just breached a trend. It's just one trend line, and it only gives me a one-sided entry or exit signal. But it wouldn't be both. If I enter and exit at that line, then I make no gain. So I have to have an angle for it to be interesting as a point of entry and a point of exit. Got it? Because I want to make a profit in excess of my $3 or $13 commission cost or whatever it is. All right, so we can address the issue of the excuse me while I set aside that call. So we can address the issue of the lines at an angle, whether there's an ascending trend channel or descending. That really doesn't make a lot of difference to me. I'm holding up the picture for the video, but Shelley, you remember that picture. We can talk about that now and why that is more useful, and I think we will, just kind of like for bookkeeping, or not bookkeeping, but for, I don't know, for planning purposes. I'll come back to the issue of the buy low, sell high kind of thing you brought up, and I'm going to call that sentiment, and we'll come back to that in a minute. And that may be all we do in this video, is we'll cover these two different kinds of trend lines, horizontal and non-horizontal, and then cover sentiment a little further. And really, those are two really great points to know as far as guiding trading. Why is a certain period of time a really good time to trade? Really clear, really useful, simple. And this is all about market. It's not about, it's about price movement and time. It's not about what instrument to choose. There's all sorts of other issues that I do intend to come back to. But for now, we're going to talk about trend lines, which is generic across all markets, and we'll talk about sentiment in a moment, which is also pretty generic across all markets. So these are nice basic things to start with. Any questions before we go on to the angled lines?
No.
Okay, so angled lines. I've already kind of tipped the hat as to why that is more favorable than a flat line. So do you want to state the obvious answer as to your understanding of what my obvious answer would be?
So you want to go with the non-flat trend lines because, I don't know, can you tell me?
Yes, I can. So the problem with the flat trend line that's a single trend line is it only gives a one-sided trigger or one-sided signal. It can be an enter signal, it can be an exit signal, but it can't be used for both to create a profit because it's flat. So if I buy at 62 and sell at 62, I might as well have not even traded.
Okay.
I've just wasted my commission, and had some risk at the same time. So if I want to, speculate and fantasize about an ideal kind of chart pattern, a single horizontal trend line isn't it. There actually could be a stack of horizontal trend lines which I could use as entry and exit signals. That is possible, but that doesn't necessarily happen as often, so I don't really want to get off on that right now. But all of this that I'm talking about is just basic stuff. I'm obviously not going to attempt to convey years or weeks of expertise in several minutes, but these are some basic guidelines that I think are simple enough. So we've got, I'm holding up the picture again of the angled trend lines. So with the angle, I'm going to go ahead and draw in some price activity there. And Shelly, you won't be able to see it, but this would be after this trend channel has already been established. And then I know this isn't really for somebody to be able to trade on their own. This is just some of the logic that I use. But I drew some erratic, bouncing price movement within my trend channel, Shelly.
Okay.
So I'll now make some marks on it. So when it's on the low side, that would be a point in time to buy. When it's on the high side, that would be a point in time to sell. And I'll now I just made some notes, so I'm going to hold it up now. Okay, so all the way, I believe it'll be on the left of someone's screen. At the bottom it says buy, and it goes up, let's say that's 62, and it goes up to 64, and then you sell. And then it comes back down to 63. It's still inside the trend channel. Can you conceive this, Shelly, or should I pause to show you what I'm talking about?
No, I can conceive it.
Okay, so it comes back down to say 63, but doesn't quite reach that bottom part of the channel. At that point, if it starts to rise, I may or may not buy. That's where I want to say, well, that's not quite as good of a. Ultimately, all of these things are in just different degrees of precision. So there's imprecision always. So if it comes close to a line, then I look at other factors and I say, well, that's an above average time. It's not average. It's now above average. There is a trend channel. It's near a buy line or the lower line of a trend channel. So if it's near that line, I might buy, and then it goes back up and hits the top line. That would be a point of sale if I was anticipating a continuing trend channel. I've actually really the way to present this now that we've had this conversation, Shelly, that I've sprung on you as a learning tool for you, I could go back and use this same, I could present this same material better if I prepared it in certain ways. But the next time it hits the sell line, let's say that's 65, even higher, another $2 gain. And then at a later time, it hits up the top of the trend channel at 66 and breaks out of the trend channel towards 67, 68. That is also interesting, but it's outside of the trend channel, so that's a different circumstance. So while it's inside the trend channel, that is a very concrete, objective, observable kind of phenomenon where I have entry and exit signals. So there's certainly additional levels of complexity, like if I buy at 62 and then it falls to 61 and a half, do I sell right away? And I didn't, I haven't addressed that issue. So there's a bunch of other issues. But as just a really generic point, you get why to have entry and exit signals creates a objective point of reference. So I don't have to get stuck in, I have a analytical guideline for trading. I have two, in other words, I have two analytical guidelines, an entry and an exit guideline that are very clear or that are reasonably clear. Okay, so I don't have to just focus on emotion. I did mention things like in a day trading circumstance, if it's coming up towards, say, 4 p.m. is when a market closes, 4 p.m. New York time, and it's 3:15. Well, at 3:15, I might be pretty comfortable with it. But once it starts to get towards 3:30 or 3:40, if I want to exit by the end of the day, then if it's anywhere close to my exit point and it's late in the day, then the specific timing makes it such that I would go ahead and close. In that case, I would close to get out before the end of the day. Does that make sense? Same kind of thing would apply if I want to, especially if it's getting toward, say I have a contract that, well, I'll just go with the simple example. So Friday is going to be the last day before a weekend. So if it's 3 p.m. Eastern time on Friday, I'm going to be even more eager to exit certain kinds of positions.
Right.
If it's coming up right before, a vacation or a period of, maybe there's a Federal Reserve announcement coming up, at 2 p.m. On a particular Wednesday, and it's Tuesday, and I know I'm on vacation all day Wednesday. I'm not even going to be there Wednesday. Well, then I'm going to get out Tuesday because I don't even want the hassle and stress of any weirdness on the Wednesday. So I just get out Tuesday, late in the day or middle of the day, whatever. So you get the idea that specific timing is another very objective thing that I can use to guide my activity.
Yeah.
Now that, while it's an objective thing, how to use timing is a very subjective thing. The trend lines conceptually are very objective in terms of how to use them. It's very simple. There's not a lot of emotion or whatever in how to use them. It's just that reality is a little different from what I put on a piece of paper, plus there's the excitement of making profits and having losses and whatever. But as a guideline, trend channels that are at an angle, they don't have to be parallel in a trend channel, like two trend lines that are parallel, but that's an ideal kind of circumstance, really, because it's simple and you can write it over and over. So if I go in at 62 and I miss my first sell signal at 64, then the market comes down to 63, my trend channel is going up. So I over time, unless it breaks my channel, I'm just going to make more and more money on that position. So that's a very good circumstance to be in. And the reality is that if the trend channel is pointing downward, I can use the same kind of methods in reverse. So it's not really an issue. Is it pointing upward or downward? That's actually trivia in most cases. But so I've just tossed in the extra issue of timing. Is it almost 2 p.m. on a day that the Federal Reserve is going to have a big announcement and everybody knows that? Is it almost the end of trading, market hours? There's some very objective things about timing that I will use for sure. And then trend lines I will use as a major point of guidance. Basically, when there's a scheduled activity Federal Reserve announcement or the end of trading, most of the time that's going to cause me to take an early exit or a conservative exit. It's not going to actually cause me to get into a trade because I want extremely high levels of certainty. And when market closes and then I have to wait till 9 a.m., 9:30 a.m. the next day or the next Monday to get back in, that's a period of whatever, 16, 18, what is it? However many hours of uncertainty. Well, I'm just going to skip that. Generally speaking, I'm going to skip all of that period of uncertainty if as long as I have a profit, or as it depends a little bit. I don't want to get too far, Shelley, into when I would and would, how to assess how important that issue of timing is. But generally, the issue of timing is going to cause an early conservative exit. That could even be taking a loss, but it just all depends. And we can come back to specific examples, but we've now gone whatever, half an hour or more probably. So sentiment, it is not just buy low, sell high. So you made that reference earlier, towards the very beginning. And then I said, well, I'm going to call that sentiment, which actually isn't the same issue, but it's related. So do you know more what I mean by sentiment from past conversations, etc.?
No.
Okay, so when I say bullish and bearish, do you know what I mean?
No.
Okay, so bullish would be a bias towards a rising price, and bearish would be a bias towards an expectation of a falling price.
Okay.
So if somebody is bearish the U.S. stock market, they expect the entire stock market to fall in price over whatever period of time.
Okay.
Okay. So sentiment refers to expectations of future price change. Is there an overwhelming expectation of increasing prices and amongst the general investing population? Or sometimes there'll be surveys just of newsletter authors or just of certain kind of analysts. So when sentiment is like 95% in favor of something and 5% against it, like 95% of the people think that market prices are going to increase and 5% think they're going to decrease. Shelley, you already have an idea of how I use that information, right?
Right.
Okay, do you want to give your short version of how I use it?
You're usually in the opposite or opposing view. When the majority of the people are expecting something, then
I'm really interested in something else happening. So
right.
How I would put it into a simple, a single word is discount. When the vast majority of investors or a particular market, people involved in a certain market are discounting something, I want to do what? They're discounting it. It's at a discount. It's on discount. So I want to do what?
Buy. I
want to buy it. How much of it? Well, I don't know. But I want to at least consider buying it because I can see that they're really discounting it. They have a really, if a bunch of people have a really negative sentiment about the U.S. stock market, like in 1982, if there's a tremendous or a significant negative sentiment, it wasn't necessarily tremendous negative sentiment, but if in 1933 there was a tremendous negative sentiment against the U.S. stock market as an intelligent purchase, and that was the best time in the 20th century to buy stocks, was when they were hugely discounted. Everyone was discounting them, which means they weren't buying them, they were selling them. Prices were super low, relative to prior times. And then it turns out that relative to 1934, 35, 36, 1933 was a long-term low, and a very long-term low, meaning prices haven't gone back to that level in the last 82 years, 81 years. So when discounting is at its most extreme, that's in a particular market, that's when I'm most interested in buying that market. I might be interested in buying that market for a year. I might be interested in buying that market for an hour. But when it is severely discounted, I'm interested in buying. And the other extreme, when a market has tremendous positive sentiment and thousands and millions of people are saying real estate always rises, or that particular market is currently 1,200 and I know it's going to be 3,000 by the end of the year or the end of the decade or whatever, right? When lots of people are making really kind of bold, optimistic statements, and it's on the cover of magazines and so then that's the opposite of a discounting. And you could call it a bubble. You could call it a buying mania, hysteria. There's a variety of terms that are thrown around, but you understand what I'm talking about, right?
Right.
So the next thing is, how do you know how do you actually compare two different discounts or two different buying manias? Is that clear?
Mm-hmm.
So how do I compare them? Do you remember? I'm assuming the answer is no, because you haven't answered yet.
Well, no, I was going to say you're looking at what's going on with trends like retirements and things like that. No?
Okay, so trend lines are showing price and time, right?
Mm-hmm.
When I measure sentiment, what is the data, what does the data sound like? I give a percentage of people who were surveyed who said they had a positive sentiment, a bullish sentiment about a particular market. And here's, in a certain survey, there might be 30% are neutral, 60% are bullish, and 10% are bearish. In that case, it's overwhelmingly bullish, right?
Mm-hmm.
And so surveys are probably the number one way that I know of to measure sentiment is surveys.
Okay.
So a survey is done on a particular day, and there you go. There's the sentiment, or that kind of thing. There's things for anybody who's interested. Put to call ratio is another measurement of sentiment. I don't want to explain what these are. I'm just going to say, in addition to straight up sentiment surveys, there are other ways that sentiment is measured in various markets. In the real estate market, you can look at prospective buyers traffic by the National Association of Home Buyers. You can look at buyers and builders sentiment, meaning price expectations. I forget exactly what they call that data, but they have data. It's survey data. Mortgage applications, housing starts, permit applications. So those are not prices. They're not sales volume, and they're not prices, but they are indicators of sentiment. Do you get how all of that stuff about real estate, all of those things would indicate sentiment?
Mm-hmm.
So if mortgage applications are down 12% month to month from one month to the next, and that's never happened before, it's like middle of the summer or something. It's not a seasonal thing. It's just, all of a sudden, very unusual from prior years, from that month to month time period. All of a sudden, mortgage applications go down 12%. Well, that's not just a sentiment indicator. I want to, all of these terminologies and ideas that I'm throwing out there, I'm oversimplifying them for this presentation, but the point is to look at leading indicators, and sentiment is one type of leading indicator. And if I just throw out the term leading indicator, I don't know if that would be clear to people why certain things are leading indicators other than mortgage applications. Shelley, is it clear why mortgage applications are a leading indicator of sales volume in the future?
Yeah.
Okay. So
if people aren't buying, yeah.
So mortgage applications correspond to demand.
Mm-hmm.
Permits and housing starts, which are related to permits, there's a variety of things that are related to supply. So we can see here's the sentiment of builders and developers, maybe even realtors. Here's their sentiment. So those are sentiment indicators. I mean, they're not literally just sentiment when you look at the actual number of housing starts filed at the county or nationwide, every county in the nation combined. When you look at housing starts, that's not just sentiment. They have to pay for that. That's a real, concrete action. But it indicates a sentimental favoritism, or it indicates a bias about the future. It's indicating their intended future action. They're making commitments. There's actually commitment of traders, data called commitment of traders. So there's a lot of different kinds of data, and Shelley, to the best of my knowledge, most of these things I'm talking about with you right now, I haven't made reference to them other than bearish and bullish. I don't think I've talked to you about them much in the surveys of bearish and bullish.
No.
But it so happens that real estate is one of the other markets where there's actually a lot of data. So people that throw out things like real estate always rises and they do no research, I'm like, wow, you're going to complain. You're going to hope for some politician to rescue you for, you know, you're taking action based on real estate always rises. That to me is like somebody going into a casino and complaining that the slot machines are unfair and they keep, you know, I put in $45 and I only got out $35. What? You know, so I don't know. That's kind of a whole different train of thought. But so there are sentiment indicators, which are a type of leading indicator, and mortgage applications would be a more even explicit leading indicator. I think they even have, like, you know, data on contracts. So when people sign contracts but they haven't closed, you know, the National Association of Realtor may actually tabulate stuff like that. So there's tons of data. If somebody's really interested in due diligence, there's in modern times with the internet and so forth, there's a lot of data that is available to people. So if they want logical, you know, analysis, it's available. If they want to read the interpretations of forecasters with a long track record of accuracy, you can see what those forecasters have to say about the data. And without getting into much detail here, I brought up real estate and I brought up, I guess, stocks. So within whatever range of markets are available, another big thing that we haven't really mentioned before is I want to compare and contrast different markets. So I want to look for what are the best trend lines that I can find. There's always trend lines in some market or in several markets. You can always find trend lines on some time scale. So what I want to do is start to look for how do I sort and select, and efficiently using my time, how do I sort and select for really attractive setups in markets. So I want to ongoingly look, I want to ongoingly think, well, I've got this great trend channel right here, but you know what? If I sold right now, even though my current position's in the middle of the trend channel, I bought it at 62, it's at 64 and a half, I shouldn't sell just based on any other factor. But wait a minute, I just noticed that over in this other market, there's a really clear, interesting, you know, development. Well, then I might exit early, or at least diversify, like reduce my position exposure. You understand? So the reality is I'm trying to give a couple little things like trend lines that are very objective, but ultimately I'm going to use every single thing that helps me to identify when is it a good time to trade and when is it not a good time to trade. So this has been a kind of a primer or a general introduction to the subject so that people can have a sense of, wow, there are a variety of things that make certain times better or worse. I guess I didn't really explain why, other than my comment about discounts. I didn't explain why sentiment is such a good thing to use, but sentiment is useful for longer term trading, meaning multiple weeks, multiple months. It's not very useful it's not in and of itself useful in a day-to-day, hour-to-hour basis because you don't have new sentiment data, right? So sentiment is actually the number one thing that I use because it's longer term, and only long term, and it sets up a bias for me. Which markets am I most interested in? So if a market is already very discounted and then it starts to rally, I'm interested in a rally in a highly discounted market. Is that clear?
Yes.
And I tend to think, well, if the price goes down, it's not going to plunge because it's already been going down for 2 years or for 2 months or whatever, right? In reverse, if a market has been going up for 2 decades very consistently and there's this overwhelming enthusiasm about it, and then some politician passes a new law to make it even better to get into that market, I'm ready to exit because there's not much more room for it to go up. The sentiment is maxed out. Everybody who's going to buy into it is bought in. There's a huge risk for, some unexpected occasion. Some company announces bankruptcy. There's a war that erupts. 1,000 things could happen that will break that trend, and I don't want to be around when that trend breaks, because that's where you have prices go from 60 to 30 in a week. Let's say Kmart announced bankruptcy. Maybe their price was 26 the day they announced bankruptcy. By the end of that day or the end of that week, they weren't in the 20s. It plunged, right? I don't know that for certain, but I'm imagining that their price was probably under $10 like the next day, or within a week or whatever it was. I don't recall. That was 10, 15 years ago probably. But when Kmart's price was 7 cents, that was the best time in the history of Kmart to buy that stock. It went up to 21 cents relatively quickly, 200% gain. When it was $26 and everybody was enthusiastic and nobody had read the reports and they were all counting on the U.S. economy to carry it, that was the worst time in the history of Kmart to own the stock. And that's just a general anecdote about sentiment, whether it's real estate, a particular stock of a particular company, the tech sector of the Japanese stock market, whatever, precious metals, whatever group that we want to pick, sentiment matters. So sentiment to me is about risk. So sentiment shows me an indication of where is risk the smallest and opportunity the greatest. And it is not a precise measure, but it's a good measure. It allows me to make apples to apples comparisons between markets. Is that clear?
Yes.
So with trend channels, with sentiment, and I didn't really look at how do I compare different markets, but maybe I don't know that I am going to talk about this in a free public video, but I look at multiple related markets and I interpret what they're doing when they're similar and when they're different. I'll just kind of tip the hat here. There's something called the Dow theory, developed by Charles Dow, famous for joining with a fellow named Jones to make the Dow Jones indices, the Dow Jones Industrial Average and the Dow Jones Utilities Average and other Dow Jones sector indexes. And the Dow theory is about comparing different sectors. I guess if you want, now that I brought it up, I can't explain that. Do you already know how that works, Shelley?
No.
Okay, I'll do a nutshell of this and then we'll conclude. But the basic point is I'm comparing markets in a variety of ways at any time. On the weekend, when markets are closed, when markets are open, at any time, I'm going to look at different markets to see how can different markets inform my activity in the 1 or 2 or 3 markets that I'm actually going to trade. So the Dow Jones Industrial Average originally was industrial giants like manufacturing companies, General Electric, things like that. You know what I mean by industrial companies generally, right?
Yes.
Utility, you know what I mean by that? There's now
utility, you said?
Yeah, like electric companies and energy companies maybe. I'm not actually sure all of what would be in the utilities average, if it would be Exxon or what, but certainly there are oil sector and energy sector and fuel sector indices and groups that are tracked that would include Exxon and Chevron and those kind of things.
Right.
But I'm not sure what the utilities average has in it, frankly. The Dow Jones Transportation Average was originally the railroad average, back before there were highways and airlines and all that stuff. But now it would be airlines. I don't know, again, really what's in the transportation sector, but airlines. There's an airline industry sector, but whatever, maybe a trucking company. I don't really know, frankly, but there are these different sectors that in the, I think the maybe 1930s, I'm not sure when, but at some point, at least as of the 1930s, and probably like a decade or two prior to that, there were a variety of different groupings, and this was back before there were computers and everything, but they would set up a kind of like a spreadsheet on a board, and they would note the prices of like 15 different companies that were all related as the same kind of sector or the same industry. And then at the bottom, they would total up all 10 of those prices totaled up, just the sum. Or maybe they would, somehow balance out the prices so that the thing that was $2.50 and the thing that was $53, they, would all be measuring percent change across all of those equally. Do you follow what I'm saying?
Yes.
So the point being, they would make some kind of a grouping, and then you'd have the transportation grouping, and you'd have the industrials grouping, and you'd have the high-tech sector grouping. For instance, this isn't what was originally done, of course. There was no high-tech sector in 1920 or 30. But as time goes on, we can create these different sectors, and we can compare the sectors. So why do we compare the sectors? Why are we interested? Your turn?
To see the best ones to buy into.
How do you know?
What the sentiments are, what the
this is just prices.
Discounts. What's that?
This is just all we're measuring is price and price change. So you can say, well, here's a market that's falling, but does that mean it's discounted in a way that I'm interested in it? It doesn't measure sentiment, it just measures price. So that's like a hint. That is a hint. So what we can see, if we've got three sectors that we're tracking. So we have the US stock market as a whole, and we can track it as a whole, right? We can also track the Dow Jones Industrial Average, the Dow Jones Transportation Average, and the Dow Jones Utility Average as three sectors of 10 or 15 or 30 companies that we group into these little small indices, targeted indices. So when all three of those indices are moving in the same direction, they're all three going up in a particular hour, in a particular week, in a particular month, whatever period of time, when they're all trending together, that's, whether it's up or down, that's all together. That is a different circumstance than when one of them's up and two of them is down, etc. Is that clear?
Yes.
So that's the situation that he was interested in, that Charles Dow was interested in recognizing quickly. When are they all moving together? And when are they as a set of groups moving divergently? One's flat, one's way up, one's down. One made a high on the 12th and a low on the 14th. The other one didn't make a high on the 12th, made a high on the 14th. When they're moving contrary to each other, like they can be moving in the same direction, but one's stronger than the other. There's all sorts of things. It allows for him to contrast bundles of stocks in this case. So why is Charles Dow and other people, why would there be an interest in contrasting these different groups to see if they are consistent with each other or not?
I don't know. I really don't know.
Okay. When they are all consistent, it tends to, it doesn't really give you any information, I guess. It doesn't give you anything useful, frankly. It doesn't mean anything predictive, but once one of them starts to diverge from a trend where all three of them were trending together, and then one of them diverges, then what? You start to wonder, what about the other two?
Right.
Okay, or it's a reasonable question.
Right.
So one of them starts to diverge. Okay, maybe we get out of that sector But then we get on high alert about the others.
Oh, okay, okay.
Are the others going to start to come down in another month, in another week, in another hour? And if you have in the case of the Dow Jones or the Dow sectors, originally there were just the three. So if one of them diverges, okay, what if two of them diverge? Then I want to get even more conservative because I think that third one might now join the other two, and you have all three now consistent in a reversed direction. So it's most useful probably to help set up exit signals. I don't know that I want to explain why that's my perspective, but that is my perspective. So it helps us to set up conservatism. I don't use it just for exit signals, but the way that I just stated it, when we're looking at contrasting markets, I mean, do you have any questions about what I said so far?
No.
Okay, so when we're looking at a variety of markets, we can use them to consider what does one market suggest about another market. I'm looking for sentiment. I actually do use sectors to look for which is the most discounted thing, because if three things are moving together, which one joined the last? I'm interested in things like that. So I don't want to say a lot more about it now, but do you get some of what I'm saying there?
Mm-hmm.
So there's simple ways to use all of these distinctions, and then more and more complex ways to use them in tandem with each other. This is the way to find highly favorable times to trade. And to find highly favorable times to trade, to me, is the right starting point. Then I consider what's my risk tolerance, what kind of instruments and specific positions are relevant, do I need to diversify, and in what ways. I get into all of those questions secondarily to when is a good time to be trading. When is it a good time to be looking for specific markets and specific, outliers and outperformers. Am I using terminology that works for you?
Yes.
So strategically, I hadn't said all of this to you. I've said pieces of it at various times, but I wanted to kind of put it together. So any comment now about having heard the whole thing, lined up? Do you get why I said that? We can stop recording too if you want me to, but while we're still recording, do you get why I've set it up this way to communicate it to you?
Yes, I'm assuming to lead me to the best place to be trading right now.
Actually, the point is right now isn't an ideal time for trading. That's part of what I was bringing up to you and recently is that the markets right now are not at a point where I'm really interested. So I'm wanting to back off a little bit and get a little more conservative. And then tomorrow or a week from now, that could change. But as of today, I don't see anything so... in fact, a few weeks ago, there were some sentiment extremes that unfortunately we didn't really get to benefit from because the discounting that had been set up, it moderated, it reduced, it started to resolve. Is that clear? So there will be sentiment extremes again. I am absolutely sure. And even, as I said, from today to tomorrow, like there's opportunities to research at any time. I want to go into a more of a research stage and less of a active trading stage, and that's going to go back and forth. And when I get really interested in trade, I'm going to even do more research, right? But right now I'm saying proportionally, I'm going to probably be looking around a little bit more and doing less trading. So right now I have a couple open positions, or a few open positions, but they are positions that I don't need them to do well this week. And also they actually have very little risk left. There's very little, if it's $100 into it, I could lose $100. But these are positions where within the next few weeks, they could become worth 150, 300, 500. They're not going to become worth 2,000, but you know, or maybe I haven't looked at them to know what I'm talking about, but generally speaking, they're really small amounts of capital that have a pretty good potential return within the next few weeks. And that's it. After about a month, they expire. So that is a specific kind of trade that is called an option contract. But I want markets to guide which kind of positions I do. And so that's something that I don't think I had emphasized to you before. I mean, it makes sense. It's not at all discontinuous with anything I've ever said. But, I just wanted to emphasize that point, is that I want to have markets guide me. And then as I do see stuff, then I can show you or anybody else. I could show the specifics of, oh, look what I found. And Shelly, you know that I've done that with you before at times where I get excited. I'm like, oh, here's a good one, Right. All right, so I'm going to conclude the video. Hope anybody who's been watching and listening has found this intriguing, and if you have further questions, feel free to contact me.